All right, guys, today's Tuesday, May the 11th. Pay careful attention to this lecture. One of these financial documents will be on your final exam. But before we get started on new material, let's review. So yesterday we talked about a company's reorder point. What is a company's reorder point? So a company's reorder point is when their inventory, their stock, gets down to a certain level. They're going to reorder more supplies. That way they don't run out. All right, so let's practice. If Quadarian sells a maximum of 50 sneakers a day and Foot Locker's lead time is 7 days, what is his reorder point? So remember, we're going to multiply his maximum sales a day, which is 50, times his lead time to get those sneakers shipped, which is 7. So 50 times 7 is 350. So when his inventory of sneakers gets down to 350 in the back, he's going to order more. That way he doesn't run out of sneakers. All right, the second part, if he wants 4 days worth of safety stock, so let's say it's Christmas time and he needs to order a little bit extra, what will his reorder point be? So we've already got 350. So we already have that number right here, but we need some safety stock. All right, so he wants 4 days worth. So that's the lead time. So 4 times, remember, his maximum daily sales, which is 50. 4 times 50 is 200. So his reorder point with safety stock, you add 350 and 200, which will give you 550. So his reorder point with a little bit of cushion, when his inventory gets down to 550 sneakers, he's going to order some more. All right, so new stuff. We're continuing with financing your business. Remember, pay close attention to this. That way you will not be confused. So businesses record their finances in spreadsheets. Those documents are called financial statements. So financial statements, that's just a collection of all the money that's coming in and leaving that business. Financial statements give a company a picture of how they're doing financially. You guys can see at the bottom, so you've got some text here, and then over here in the columns, you've got some money. That's money that's coming in and money that's leaving that company. So we're going to look at two different financial statements today. One is a balance sheet and the other is an income statement. So I'm going to skip all this stuff and get right to your actual documents. So this first one is a balance sheet. This tells the company where they stand financially in the future. It looks at their current assets, which are things that a company owns. So what we own, what we're worth as a company, what we've bought over time, and then it compares it to our debt, the money that we are actually in debt for. So money that we may owe the bank. So that's what we're looking at, part of the company that we own, and then part of the company that we are still in debt for. So with your balance sheet, you got your current assets. Under current assets, assets are things that we own. We like assets. We like assets. Those are the things that the company owns. We have cash in the bank. We have accounts receivable. So these are accounts, companies' accounts that we actually are planning on receiving money for. So these are companies or customers that actually owe you money. You have inventory, which is your stock in the back. And then you have company supplies like desks, computers, anything that's worth anything of value that's inside the office. So you add all those things up, which gives you your total of how much of the company that you actually own. And then you're going to look at your liabilities. That's your debt. You've got short-term liabilities, which is this is debt that you actually owe others right now. So that's called accounts payable, because those are accounts that you are paying on. That's money that you owe others. And then you've got long-term debt, which would be like your loan payments. Loan payments would be like a debt that you owe the bank. So that's a debt that you're going to pay off over a long period of time. And then you add up your total debt. Now, to get your owner's equity, or actually how much of the company that you own, you're going to take your total assets minus your total liabilities. So what you own minus what you owe, and that'll give you the actual amount of the company that you own. That's the value of the company that is in good standing. You always, of course, want that number to be high. So you want your owner's equity, or the value of the company that you own, to be high. It's almost like a house. So your house is an asset. So as you pay your mortgage payment over time, you own a part of that house, but another part of it is still owned by the bank. Same thing, we're just talking about a company. So companies own parts of their stuff, like the building and company cars, but then part of that stuff they're still paying for. It's still part of their debt. So your balance sheet is a look at the future of, okay, where do we stand financially? Are we secure? Do we own more of the stuff that we have, or are we in more debt? Now, the second financial statement that we're looking at is an income statement. This is a current look. So can we pay our monthly bills? How do we stand right now with our cash? This is called an income statement. This is the one that you guys are actually going to type in Google Sheets. So with an income statement, it records your sales. So how much money do you have coming in from customers, which is your net sales. Now, from that net sales, you've got to subtract the cost of the goods that you're selling. So this is like your inventory. So when you actually buy stuff that's in your inventory, you're going to subtract that from how much you're selling. And that'll give you how much profit you're making. It's called gross profit. But from that profit, you've got to subtract all of your expenses. Your expenses are things like your payroll, paying your employee's salary, advertising, like commercials, billboards, your rent, your power bill, your utilities, maintenance, just routine maintenance, calling in a computer specialist to fix something that's going on with your computer system, insurance, and then just, random stuff that comes up that you got to pay for. So you'll add all of your expenses together, and then you'll take your gross profit minus your expenses, and that'll actually give you your net income. And that's before any kind of taxes are taken away. So your income statement looks at, can we pay our bills right now? So how are we doing financially right now with the cash that we have in the bank? So let's actually go to your assignment. So what you're going to do, you go to your Google account, you go to your Google Apps, and just like you can go to a new document, you're going to go to a Google Sheet. So you're just going to create a brand new blank Google Sheet. And then you're going to actually start typing a document here. The document that you're going to type is in Canvas. So go to Canvas. On our homepage, you got submission link, income statement. So you're going to type an income statement today. So key the following information in Google Sheets. Use your notes to understand how to calculate gross profit, which is what I just covered, total expenses, and net income before taxes. Use Google Sheets as a calculator, and you can do that by using that little equal sign and then typing your numbers in. Submit your Google Sheet in Canvas titled Income Statement and your actual name. So Tara McDonald, Keasia Pittman, Joshua Crumpler, whatever your name is. This is the document that you'll type. So I would open this up, and I would have this over to the side along with your Google Sheet. And that way you can actually see what you are, what you're typing. So I've got both documents up, and you can resize these. But you're going to start and you're going to type XYZ income statement, December 31st, 2021. And then you're going to come over to one of these columns. I don't care what column you use, A or B. I'll start with A. I'm just going to resize that for you. And this is going to be revenue, which is your sales. And then under that, you can do net sales. And space over a little bit. This is going to be 450. Under that is cost of goods sold, which is 250. And under that is going to be gross profit. Now, if you want to use spreadsheet as a calculator, which is what I want you to do equal to. And for net sales, you're going to subtract your cost of goods sold. So 450 minus 250. So your gross profit is $200,000. And then of course you can do that as money and increase or decrease your decimal places to make it $200,000. And then you're going to come down here, do your expenses. And your expenses is going to be salaries, which is 70,000. And then keep going. And then at the bottom, you're going to actually say total expenses. And then you're going to add all of your expenses. So 70,000 plus 14,000 and keep going. And then after you get your total expenses all typed in there, you're going to do your net income. So let's say that I'm down here to my net income. Net income, I'm going to do equal to whatever my gross profit was up here at the top. That was 200,000. I'm going to do equal to 200,000 minus my total expenses. And that'll give you my net income. And then you actually submit this document here in Canvas. And you guys know if you have any questions, you let me know. Okay, make sure you go into Canvas and also do your exit ticket, and then I'll see you guys tomorrow.